Chapter 1. Start Smart. Understand the basics. 1.1. Why investing in 2025 is a must in 2025. Investing has become a necessity, not a luxury. Traditional savings accounts offer minimal returns that often don't even keep up with inflation. Simply, saving money in a bank is like watching your hard-earned cash lose value every year. Thanks to modern technology, investing is more accessible than ever. You no longer need a financial advisor or thousands of dollars to get started. Today's apps let you begin with just a few dollars and offer beginner-friendly tools like auto-investing, educational videos, and simulations. Apps like Robinhood, M1 Finance, and SoFi allow fractional investing, which means you can own a piece of expensive stocks like Google or Amazon for just $5 or $10. Additionally, artificial intelligence, AI, and machine learning have changed the way markets function. Robo-advisors use algorithms to build portfolios based on your goals and risk level. These innovations have made investing smarter, faster, and more efficient than ever before. 1.2 Don't believe these common myths. Myth 1. I need a lot of money to start. Wrong. Thanks to fractional investing and zero-commission apps, you can start investing with as little as $1. Many platforms have removed minimum deposit requirements, allowing you to test and learn without a large initial commitment. Myth 2. Investing is like gambling. This belief is common but untrue. Gambling is based on luck. Investing is based on research, trends, and data. If you invest in well-established companies or ETFs for the long term, your odds of building wealth are very high. Myth 3. I need to be an expert. Not at all. Many tools are designed specifically for beginners. Index funds, ETFs, and robo-advisors simplify the process so you don't have to pick individual stocks or study financial reports. 1.3 Before you invest, get your money-ready emergency fund before investing. Build an emergency fund that covers 3 to 6 months of living expenses. This money acts as a safety net in case of emergencies like job loss, medical issues, or car repairs. Keep it in a high-yield savings account for easy access and small interest gains. Budget smart using 50-30-20 rule. 50% of your income goes to essential expenses, rent, utilities, groceries. 30% goes to non-essentials, entertainment, shopping, travel. 20% goes to financial goals, saving and investing. This method helps you stay disciplined and financially balanced. Tackle high interest debt. If you're carrying credit card balances or personal loans with high interest, focus on paying those down first. It makes little sense to invest for a 7% return while paying 25% interest on debt. Once high interest debt is cleared, you can direct that freed up cash toward investing. 1.4 Think like an investor. Stay.com. During market fluctuations, markets will rise and fall. Emotional investors tend to panic sell during downturns, which leads to losses. Successful investors remain calm and trust the long-term growth of their investments. Be patient. Investing is not about overnight success. It's about compound. Your investments earn money, and that money earns even more money over time. The earlier you start, the more time you give your money to grow. Don't time the market. Trying to predict the best time to buy or sell is extremely difficult, even for professionals. Instead, adopt a strategy called dollar-cost averaging, where you invest a fixed amount regularly. This spreads your investment over time, reducing the impact of market volatility. Chapter 2. Know where and how to start. 2.1 Choose the right investment accounts to invest. You need a place to put your money. Brokerage or investment account. Here are your main choices. Traditional brokerage accounts. These accounts let you buy and sell investments like stocks, ETFs, and mutual funds. Popular choices include Robinhood, great for beginners, no commissions. Fidelity, reliable and great. Customer service. Webull, good for advanced charts and analysis. Charles Schwab, strong long-term support. These accounts are taxable, meaning you pay taxes on your earnings, but you can withdraw money anytime. Retirement accounts. These accounts help you invest for retirement and come with tax benefits. 401k, offered by employers. You contribute a portion of your paycheck, and some employers even match a percentage-free money. Roth IRA, you contribute after-tax money, but your investments grow tax-free, and you pay no taxes when you withdraw in retirement. Traditional IRA, you may get a tax deduction for your contribution now, but you'll pay taxes when you withdraw later. Robo-advisors, if you don't want to manage your own portfolio. Robo-advisors like Betterment, Wealthfront, and SoFi Invest do it for you. You just answer some questions about your goals and risk tolerance, and the app handles the rest. 2.2 What can you invest in? There are many types of assets. Understanding each helps you build a balanced portfolio. Stocks. A stock is a small ownership share in a company. When the company grows, the value of your share rises. For example, if you bought Amazon stock years ago, your money could have multiplied many times. Stocks can be volatile, but they also offer high growth potential. ETFs and mutual funds. ETFs, exchange-traded funds. These are baskets of stocks that trade like individual shares. For example, VTI Vanguard Total Market ETF gives you exposure to the entire US stock market. Mutual funds, similar to ETFs but often actively managed and sometimes with higher fees. ETFs are better for beginners due to lower costs. These funds will help you diversify, which means spreading your money across many companies to reduce risk. Cryptocurrency is digital money. The most well-known examples are Bitcoin, BTC, and Ethereum ETH. Crypto can deliver big gains but also has it swings. Only invest a small portion of your money here if you understand the risks. Real estate, you can buy physical property to rent out or invest through REITs, real estate investment trusts, companies that own income-producing real estate. They pay dividends and are traded like stocks. Bonds are essentially loans you give to a company or government, and they pay you interest. They are considered safer than stocks, though returns are usually lower. Alternative investments, these include startups via equity crowdfunding platforms, gold and silver, NFTs, or art. Risky and speculative. These are not necessary for beginners and should be approached carefully. 2.3 How to choose what to invest in. Understand risk and time horizon. Ask yourself, how long before I need this money? Can I handle seeing my portfolio go down sometimes? If you're investing for 5 to 10 plus years, you can afford more risk stocks. If you need the money soon, go safer bonds. High yield savings, research tools. Learn basic metrics. PE ratio, price to earnings, tells if a stock is over or undervalued. Market cap, the total value of a company's shares. Big companies equals more stability. Revenue and earnings growth, is the company growing each quarter? Use websites like Yahoo Finance, Google Finance, finviz.com. Seeking alpha course at Light Strategy. Great method for beginners. Core, 80% equals safe. Diversified investments like total market ETFs. Satellite, 20% equals individual stocks or crypto for growth potential. This gives you a stable base with room for higher returns. 2. For best tools and apps to get started for investing. Robinhood, free trading. M1 Finance, automated investing, great for long-term portfolios. Fidelity and Charles Schwab, full-service platforms with great support for crypto. Coinbase, great for beginners. Binance, lower fees and more coins. Ledger or Trezor Wallet, for secure crypto storage. For budgeting and tracking. YNAB, you need a budget, helps you allocate every dollar in simple tracking and budgeting. Empower, formerly Personal Capital, tracks investments and net worth for learning. Morning Brew, CNBC, MarketWatch, Financial News. Reddit, are investing. TikTok Finance, YouTube channels. Graham Stephan, Andre G. Chapter 3, your first $1,000 investment plan. 3.1 Save that first $1,000. Saving your first $1,000 is one of the most crucial steps toward building wealth. It's not just about the money, it's about proving to yourself that you can build the habits needed to grow financially. Step-by-step savings guide. Track your spending. Use an app like Mint, YNAB, or a simple spreadsheet to understand where your money goes. Cut unnecessary expenses. Pause subscriptions, reduce takeout, or switch to cheaper alternatives for daily expenses. Automate savings. Set up automatic transfers from your checking account to a savings account every payday. Create a no-spend challenge. Pick 1 or 2 weeks a month where you don't spend anything outside of essentials. Start a micro side hustle. Deliver food, sell digital designs, offer tutoring, or do AI freelancing tasks. Even $5, $10 day adds up quickly. Example, if you save $10 day for 100 days, you've got $1,000. 3.2 How to invest the $1,000 once you've saved your first $1,000. The goal is to invest it wisely. Here's how to build a simple, diversified beginner portfolio. Sample allocation, 60% ETFs, $600. Put this in a broad market ETF like VTI, Vanguard Total Stock Market, or SPYS and P500. These funds include hundreds of top companies and offer instant diversification. 20% growth stocks or thematic ETFs, $200. Invest in sectors with future potential like AI, for example, QQQ, ARKK, Clean Energy, ICLN, or Healthcare. 0.10% crypto, $100. Buy Bitcoin, BTC, or Ethereum ETH. If you're open to a little more risk. 0.10% cash reserve, $100. Keep in your brokerage as dry powder to take advantage of dips or corrections. Platform options. Robinhood, M1 Finance, great for no-fee ETFs and stock purchases. Coinbase, Binance, used for small crypto purchases. TEP, buy fractional share. Worry if you can't afford one full share of Amazon or Google. Use fractional investing to buy pieces of expensive stocks with as little as $1.3. How to make your first investment. Open a brokerage account. Use apps like Robinhood, Fidelity, or M1 Finance. Link your bank account. Fund your brokerage with a transfer. Usually takes 1 to 2 business days. Pick your investments. Use your saved plan from section 3.2. Place your first order. Choose a market order, buy instantly, or a limit order. Set your price. Enable auto invest. Automatically invest a small amount monthly to take advantage of dollar cost averaging. What is dollar cost averaging? Instead of investing all your money at once, you invest a fixed amount regularly, like $100 a month regardless of market conditions. This strategy helps you avoid buying high and reduces emotional investing. 3.4. Stay on track. Track performance. Use portfolio trackers like Empower, Yahoo Finance, or your brokerage app to monitor performance. Review quarterly every 3 months. Revisit your goals. Check for underperforming assets. Rebalance to maintain your 60/20ths 10/10ths ratio. Stay emotionally disciplined. On panic during market dips. Don't chase hype. Stick to your plan. Always invest based on logic, not headlines. Chapter 4. From Starter to Wealth Builder. 4.1. Grow beyond $1,000. Once your first $1,000 is invested, your next focus should be increasing contributions and growing your portfolio. SUSTAINABLY. Increase contributions. Pay yourself first. Make investing a fixed part of your budget, just like rent. Boost with windfalls. Allocate part of tax returns, bonuses, or birthday money to your portfolio. Automate raises every time you get a raise. Increase your auto-invest amount by 10 to 20%. Reinvest dividends. Enable DRIP dividend reinvestment plan in your account to automatically use dividend payouts to buy more shares, compounding your returns. 4.2. Advanced strategies. Once you're comfortable with basics, here are ways to step up. Sector-specific investing. Focus on industries you understand and believe in: technology, AI, cybersecurity, semiconductors, healthcare, pharma, biotech, telehealth, sustainability, clean energy. ESG funds. Real estate investing. Physical property. Buy a rental home or house hack by renting out a room. REITs. Low costs, low barrier real estate investment via stocks like VNQ or Fundrise. Swing or active trading only after you've built a solid passive foundation. Involves buying low, selling high in short time frame. It requires more research, time, and risk tolerance. 4.3. Plan for the long-term. Plan for financial independence. Re equals financial independence. Retire early. It's about investing aggressively to achieve financial freedom earlier in life. Save 40 to 60% of your income. Invest in low-cost ETFs and dividend stocks. Focus on building passive income streams. Set up generational wealth 5 to 9 plans for your children's college savings. Custodial accounts. Let your kids start investing early. Estate planning. Wills, trusts, and legacy planning. Ensure your money supports loved ones. Smart giving. No advised funds. DAFs let you give to charity while receiving tax advantages. Giving is a powerful wealth habit. 4.4. The Investor's Manifesto for 2025. Consistency over perfection. A good plan done regularly beats a perfect plan done rarely. Automate everything. Auto-transfer, auto-invest, auto-pay. It removes emotional decision-making. Keep learning. Watch YouTube, finance. Read books. Follow credible creators. Avoid the noise. News and social media hype are distractions. Follow data, not drama. Play the long game. Think in decades, not days. Celebrate progress. Track your milestones first. $1,000, $10,000, $100K, and reward yourself modestly. Conclusion. By following this step-by-step guide, you've laid the foundation to become a confident, long-term investor. You don't need to be rich, lucky, or a genius. All you need is a plan, discipline, and the courage to start. Your financial future is in your hands, and it starts today.